There is a chat button on the bottom where you can write your questions either during the session, either after, whatever you decide. Of course, I hope we'll be able to touch all the topics for the basics of trading, and from there on, let's see how things will develop. All right, so let's get started. During the session, if somebody joins a little bit later, it's not a problem. As I said, we can have quick chat questions in the end, and so we'll cover all the topics once more if somebody needs more details. So, basics of trading is our first event. As a beginning, we are going to talk about the event's agenda, meaning like what are we targeting here, what is the basic idea of trading, what basic terms we have in the trading, some small profit loss calculations, some very basic profit loss calculation we'll be able to cover. Afterwards, we will be talking a little bit of how to recognize regulated entities into the market, so you know exactly where you're investing or with what kind of company you're involving yourself. And in the end, we are going to talk a little bit more about our partners, what kind of benefits you can get with our partners, and of course, what you can expect from your trading in general. So start with the first thing is the basic terms of trading. I know some of you may have experience, some of you may not. This is not the point. The point here is for you to learn the basic idea of how to approach the market, how to approach the investment world into a level where you know what you're doing. Like either right now you are involving yourself into buying or selling into the market. So the main idea of you trading is to work on the world events, to work on the financial market by buying when you're expecting the price to go up, selling when you expect to the price to go down, and furthermore to get more involved into the specifics and the bits and pieces of every trading platform. So in the basic terms, we're going to discuss buy direction into the market, sell direction into the trading market, spreads, meaning the difference between buy and sell, position size, meaning when you are trading and you're involving yourself into any trade, any position, how much exactly from your balance you're exposing to the market at a specific moment or a specific trade. And also we're going to cover the chart as the first and most basic tool on predicting market movements. So we start with the buying direction. Buying, or as you can see here, the technical term is a long position. Buying position or long position into the market means that when you buy specific product, whatever it is it a currency, is it a commodity, is it an index, is it shares, stocks, whatever you do when you buy, this means that you're expecting the price to go up, the price to increase in value. When I'm buying, it means that I saw something that is notifying me, that is giving me the idea of expectation for the price to increase in value. This is why I go for a long position or buying position in the market. As it's written here, you can buy when you see the price of a product is continuously increasing in value, or if it is in the so-called uptrend. Let's put it this way, as more technical term. So yes, when we enter into an investment platform, in a trading platform, and you want to take advantage of an upwards movement of the price of a product, as I said, regardless if it is a currency, commodity, stock, share, whatever index, you can open a buying position onto the market. Obviously, if we have to cover the opposite side, if we have to cover the counterparty of the buying position, this would be a selling position or selling direction into the market. In this particular one, we are covering the drop of the price. We are selling when we are expecting the price to go down. The technical term for selling is the so-called short position. Basically, you go long when you're expecting something to go up, and you go short if you're expecting something to drop, some product. As I said, currency, commodity, stock, index, share, doesn't matter. Okay, so you can sell when you see the price of a product is continuously decreasing in value. If you see there is a so-called trend dropping down, that the pattern that you see with this particular product is for dropping. This is when on a trading platform you can open a sell trade and still make some profit, some income from the drop down of the price. So buying, we go, or long, we go when we expect the product to increase in value, to increase as a price, and selling, or we go short when we expect the price of the product to drop in order to generate profit trading or speculating into the market. Okay, when we talk about trading and speculation, we should always discuss the spread. The spread is something that every single trader from all over the world will be able to notify, will be able to see and recognize whenever you open your trading platform. It doesn't matter which platform you're using, you'll be able to see buy and sell prices, something that we just discussed. If you click on the buy button, you're entering the market with the buy price. If you click on the sell button, you enter in the market with the sell price that you see in front of you at that particular moment. But how to know the spread, how to know the commission that the companies take as a provider to the service for you to trade in the market? Well, you can notify this with something very easy. You can simply see the difference between the buy and the sell price, the two buttons that you have on your platform. As I said, all the platforms in this particular situation are the same. They have buy and sell options. Whatever you see as a difference between these two prices, this is the spread of the company you're working with. Now, if I have to go into details for every specific type of product, meaning, again, I will go over them once more: currency pair, commodity, index, stocks and shares. This cryptocurrency, all these products, they have different spreads. They have different taxes on operating them in the market. So whenever you want to know exactly what will be the spread, what will be the commission of the company for a specific product that you like, the only thing you need to check is the difference between the buy and the sell price. Another way for you to check it is, as I have written here, indication the spread once opening a trade, meaning once you enter into the market with 1 unit of this product, 2, 3, or whatever, you simply see on what amount your trade is starting into the market. That negative amount that you will see once you open it, once you start it, this is the spread easily calculated for this particular position that you have opened. Now, the difference between the buy and the sell that I mentioned on your platform is simply the basic spread on this particular product. But if you open different size of position for this product, not only 1 unit, but let's say 10, 20, 50 units, you'll be able to see below, once you open it, the minus in particular for this particular position that you have opened, this particular amount that you have entered with. And that is how you can easily notice. All right, I see the spread, let's say, is $1, but I opened 10 as a quantity of this product, meaning that my position will be starting like on minus $10. As easy as that. We go forward. We have here position size. something that I've just mentioned, I have just touched in our previous slide. Now I will explain it more in detail. Now, there are different platforms all over the world. Some of the most famous ones, some of the most, let's say, used into the trading world are the MetaTrader 4 and the MetaTrader 5. Many companies also provide their own trading platforms that can be even more simplified than the MetaTrader 4 and 5, because these ones that I'm talking about, they are the most common in a reason that they are designed more for experienced traders. If you're a beginner trader, you can always try your luck and use the MetaTrader 4 and 5 and try to get into the big game on the first go. Or you can simply check a platform that a specific company is designed for beginner traders. Now, the position size that we are talking about is, as I said already, is for you to know exactly how much you're involving yourself into the market. For example, we have main definition of position size or position volume. One unit of a product generates specific size into the trade. Working with the position size and the position volume, we will be able to help you navigate your risk. Meaning, if the position size or volume, basically different platforms call it different way, it will help for you to decide, like, I want to go with with all of the capital that I have available on one go into the market, or I want to separate my investment, I want to separate my position sizes, position volume on couple of entries. Working with the position size and volume, you'll be able to control the risk for yourself into the market. Now, I have put here some of the basic terms, like one lot into the market means 100,000 volume on currency pairs, or something like 100 ounces of gold into trading with gold, let's say. So if your account is a small account, this one lot can be huge volume for you, meaning you need all your capital to support this trade onto the market. It's very important to monitor and to manage your position size when you're trading on the market, because this is exactly how much of your capital you are involving into the market, with or without the leverage of the trading company you're working with. Meaning, if you're putting too much at once on one trade, on one go, you are mostly gambling than actually trading. If you put everything you have in the trade, in one trade, this obviously gets into a situation on whether you make money out of it or you lose everything. So if you diversify, or if, let's say, you try to separate, to partial your investment into different trades, yes, they will be with low volume, meaning you're expecting less profit out of each and every product, but at the same time you cannot expect this particular trade or position into the market to cut you off at one slap. Why? Because you are using the full amount of your investment into only one trade. So yes, whenever you're trading, no matter if it is with a MetaTrader platform or some other customized design platform, you need to be careful on how much of your balance, how much of your capital you're putting on one trade only. So you know you have room to maneuver. You know you have room to manage your investment. We continue further with the chart. I already mentioned that you can go for a long position, for a buying position, whenever you're expecting the price to continue growing forward, upwards, or you can go for short or downtrend whenever you're expecting the price to drop. So here on this particular slide, I have managed to show very basically, very simple, what is the so-called uptrend and downtrend, meaning if the price is tending to mostly grow upwards, which can be the long position for you, the buying position, or if the price is trending to go down, it is expected for the price to continue dropping, so you can go for a selling direction. The basic term of the chart is that you check the price movement, you check the let's the development of the price, whether for the past hours, days, months, it has been growing or it has been dropping. If it has been growing, you can expect more upwards movement. This is the uptrend. If it has been dropping continuously, this is a downtrend, so you can expect a further drop. The main idea of up and downtrend is if the price is moving from bottom left to top right onto the chart, this is an uptrend. If the price is moving from top left to bottom right of the chart, this is a downtrend. You can recognize the down. Yeah. Okay. I see people raising hands here. If you have any question, you can simply write in the chat. I'll try to answer it, especially if it's about the specific of this particular slide with the charts, or if it is in general with the topic that we have today, basics of trading. So if you have any question, you can write it in the chat. Otherwise, yeah, I see that you're raising hands. Okay, I'll wait a little bit for this and I will continue further. Now, profit loss calculation. This is important and it is connected to what I have just told you a few minutes ago about the spread and about the size of your trade, about the volume of your trade. Whenever you are trading and you see a specific movement is about to happen, you can easily calculate for yourself the profit, the potential profit or the potential loss that you can expose your account with to. In our situation from last week that we also covered in one of our YouTube videos about the US dollar and the gold, you'll be able to see very simple how only for a couple of hours the price of the gold increased drastically, sharply upwards. And in this particular situation, the size of your position, the volume of your trade, can actually bring you to a level where you can easily benefit only for a few hours from a good trade on the market. Here on the slide, I have shown already. It was a $60 movement on the price of the gold at that point last week after the interest rate decision that was announced in United States. Another topic that most probably we'll cover in our next webinars. But the main point here is this. If you trade with gold and you have bought 1000 ounces of gold with 60 points of movements upwards last week, you could have made 1000, which is the size of the position, multiplied by 60 points, $60 up for the gold, which is 1000 times 60, which is $60,000. As a trader, it's very important for you to be able to place yourself, to position yourself into the market at the right time. Of course, furthermore, you'll be able to learn how this positioning can go. But in the end of the day, it is also important of how you can calculate the movement and how you can calculate the potential profits that you can gain and how to protect yourself from potential losses. This is exactly why we're having this example. The size of the position and the movement can be something that can guide you. 60 points movement multiplied by the size of 1000 ounces, $60,000. 60 points of movement multiplied by 100 ounces of gold can resolve on $6,000. And these 60 points of movement, as you can see, the movement is the same we're taking the example, the movement from last week, multiplied by $10, I'm sorry, by 10 ounces, it can resolve on $600 potential profit. So depending on the size of the trade, the potential profit or loss is changing. The movement is the same for everybody. It doesn't matter if you're new or experienced into the market. The movement on the market is the same for everyone. The question here will be how much you can work with, what you can involve yourself with, and what kind of potential profits you can expect, and what kind of potential losses you can protect yourself from. So the movement is always 60 points upwards for the gold last week, and only the size of the trade is the one that is actually making the difference. Continue further with how to recognize the regulated entities. Now, many people try to do that by making online research. There is a good and bad thing when you do online research. Now, if we focus on researching the certificate of the company that you're planning to work with, like the regulation number or the certification number of the company, to search it online into the regulator website, it's one thing. By simply typing the name of the company in Google, it's a totally different thing. And I'll tell you why. If you go with the regulator, the official representative of financial authorities in your country, doesn't matter which country it is, either it's European Union, either it's outside of the European Union, it really doesn't matter. Every single country has its own regulator. So if you have a company that is registered with this regulator, you simply check the number of the registration and you go there to see if everything is in order, if this number is actually true or is just a number stated on the website of this company that is not really valid. This is very important. But if you do online research, like you decided to go with company X, you go and type in Google company X review, you will be always you will always be able to see good and bad reviews for any company that you see out there. So taking a decision, an informed decision, by only reading people's thoughts may not be the best way to go about it. Why? Because there are people making profits trading in the online world, there are people losing money. The online trading is one of the most popular lately ways of you generating additional income for yourself. And as everything popular, it has its fans, its supporters, and also people that go against it. So that's why just going into Google and reading everything about trading, everything about companies online can only get you crazy because you see so many opinions, so many things, goods, bads, pros, cons, whatever. The way for you to approach such kind of investment research should be, first of all, if the company is eligible entity, if it is really registered, regulated, and following the laws. Because if it is so, if it has a valid license, this means that if by any chance there is any wrongdoing to you as a client, you have somebody to consult with. You have somebody to address this problem too. Otherwise, if it's not following these rules, obviously we have a problem. Okay, continue further. Get special bonuses from our partners. Now, I already finished the topic with people going online, searching for many companies and trying to find the best one for themselves to make some good income from this, as I said already, very, very popular way of investing, trading into different trading platforms. We work with couple of companies that are registered, checked, and they actually can provide the service that people are searching for. So if by any chance you decide to sign up with one of those companies, you can easily contact us on traders lessons, either through Facebook, either through WhatsApp. That really doesn't matter. You can contact us, and actually ask about your region in particular. If there's any company we're working with, we are partnering with in your region, and what kind of bonuses or benefits you can get simply by saying that you have been referred to this company due to traders lessons. And the last one, I would like all to thank you all for participating this session today. I would like for you to find us on Facebook. I would like you to subscribe to our YouTube channel that I already referred to, where we are covering huge events, big market movements, and also a lot of information for beginner traders of how to read calendars, charts, and everything that you need to know into investing into the trading world with any platform that you're using. Also, you can even visit our website www.traderslessons.com. Be part of our community and focus on making trading your next successful investment. Thank you all for your time. Thank you for being part of Traders Lessons and being part of our webinar session. And I hope to see you all next time on our next topic. Goodbye.